Hello everyone, a very good morning, good afternoon and good evening to all. Myself Vaibhav. In today's session of automated trading, we are taking a look at how to exploit the overbought or the oversold situation with the help of WillR. And you might be thinking that we will be looking for contra trades when the overbought situation is there. We will be looking for sell, or when the oversold situation is there, we will be looking for buy. But that's not what we're gonna do. We are looking for trading with the trend, even though the situation might be looking overbought or oversold. It is pretty much possible that it might continue for some more time, and if we get involved in the initial hours or initial minutes of the conditions getting overbought or oversold, I think the possibility is a lot higher that we might be making money even in such a scenario while playing with the trend. And also, many a times the instrument is trending when it enters overbought or oversold scenario, and that strong price action can also be pretty helpful for making us some decent gains. So for that matter, we are going to use this Williams percentage R. This is a technical indicator, and it helps us determine whether the market is overbought or oversold, and it is pretty much similar to the stochastic oscillator, only that the scale is upside down, means it is marked in negative connotations. The ATR, average true range, it is pretty simple. We use it all the time to determine the entry and exit points. And before we get started for the day, this is a standard disclaimer here. I would like to remind you that this session is simply for the tutorial purpose, and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if you want to use any of it, I would recommend that you do extensive trial runs and also run it on the demo account for sufficient enough time to get an idea of the efficacy of the said algorithm. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. On that note, we start the day. We will first see how we are planning to set up our algorithm. So as you can see, whenever when the instrument goes into a overbought or oversold territory, so see here it is looking pretty much oversold. It is in the overbought scenario, then here it is again in oversold, overbought, oversold, overbought. So it keeps happening all the time. But what happens many times, even after getting into overbought or oversold scenario, it keeps trending. And in such scenarios, I feel that if we play with the trend, we are more likely to end up making money than losing money. And of course, then the question arises is what should be the exact entry and the exit point. So for that, I was looking at some formations where I found a decent probability of ending up in profit. Of course, when it will be fully complete, you can do your own testing. But even from my experience, I have felt that suppose if we go in for the overbought or oversold scenario in the initial minutes, we are basically in today's session working with these 10 minutes chart. So this whole setup is going to be for scalping purposes, and we are looking at from the short to medium term perspective. Even not medium term, it is a purely intraday play, as we will be targeting the stop losses and the target price based on the average true range of the 10 minutes candle. So it might be even sometimes 1 pip, sometimes 20 pips, sometimes 5 pips. So it will keep varying. The target and the stop losses will be determined by the volatility of the underlying instrument. We are not going with the fixed target or the stop losses. We will let it the volatility of that instrument for that particular moment define and guide us. So we will keep it dynamic. And now we will try to see what can be the scenarios where we will be in a position to go in for a fresh trade. So as you can see, we are looking for the Williams percentage R when it will be above -20. We will be looking for the buy. And just I think a couple of sessions back, we were working with Williams R on the hourly chart, and that day the setup was we were going back three candle periods, and now if it is of 10 minutes, it will be like 30 minutes. So we look back and see if the candle with shift 3 was in overbought or oversold scenario. So we do the same here. We see that it should have been in the overbought territory at least for some time, and it will also make sure that the price action has been strong and it is sustaining the upward momentum. So we do that, and then we look at the last candle closing, and it should have closed with some corrective momentum. So here it has closed in red, here also it has closed in red, here also it has closed in red. But we look at instances where it has closed even below the prior candle's open price, and the last candle should be the prior candle should have closed in green, that is means it should have closed with gains, and now in the next candle there are some losses, it is closing lower, and we look at that scenario, and we want its closing to be even below the prior candle's opening price. So that is going to happen here, and then after that we add up some say 20-30 percentage of the ATR of that 10 minutes candle, means not that 10 minutes, at that point in time whatever is the ATR. So here the ATR is of around 3 pips, so we will add say 1 pip, and we will push the order higher, and then whenever the price starts to rise again, we will go in for a fresh buy trade. Now the obvious question that arises next is that it will keep buying even when the momentum starts to shift on the downside, and for that because at some point in time the momentum will wane, and then our underlying instrument will uh, start experiencing candles which will be closing lower, and at such point in time we don't want to be executing the trade. So what we do, we go back say 12 candles, and now that we are utilizing on candles of the 10 minutes, that will be like roughly 2 hours. So we see if 2 hours back the instrument was in a oversold scenario, and now from there on, from those lows, it picked up the momentum and entered into a overbought scenario, and then we only limit that time. So what will happen, only during the initial phase the buying will happen. So here the last time the Williams R is in oversold scenario is at GMT 21.40. So if we add 2 hours, it will be like 23:40. So we go and check when will be the last time or trading range or our requirements will be in play. So that is only till 23:40, and that is somewhere till here. Now what happens here, this is happening after fresh day starts, and around 20 20 GMT, so we won't be in a position to go in for a trade at this point in time, and then no buy trade will happen only when it enters into oversold scenario, and then if the conditions are fulfilled as it is looking like here, I think then one more thing is that we also want it to be the oversold scenarios to have happened 3 candles back, that is 30 minutes back. So we have to wait till 4:10, and then we have to see if the candle was closing lower. So what happens here, also the trade will not happen, as immediately it kind of bounces back. So we again can't trade, and then it kind of moves on. So because of such setup, we won't be suffering too much of undue trade, and trading will happen only during the initial phase of the change in momentum, and we will be pretty much safe from unwanted trading. We can even put in some other conditions. Suppose if you want to do that, you can even optimize it further. But that is the basic idea, and I think once we taste it, we will get a clear, better idea of whether it is going to work or not. So let's start to build it now. We will need a Williams R. So we get the Williams R here. We are going to need the Williams R of shift 3, then the Williams R with shift 12. We are not looking at the current Williams R value, so we can make do with these two blocks. Before that, we also need the if blocks. We need to do the instrument subscription, and then we also need to define the position amount. We don't want for the positions to open if there is already one position on the account. So for that we do the position amount, we set it at 0. So here I think we will be better off if we use these on tick. We will color code it so that we immediately spot if the flow is not going through. Now let us bring in the default instrument, and then we look at the tick instrument. So the default instrument should match the tick instrument, and the tick instrument should match the instrument which we are going to define. And no prices for guessing. Basically, most of the time we work with the Euro USD. Today also we will work with the Euro USD. And then we go to the position amount, and for that we will need all position amount, which will be defined at 0. So we connect it here. The last tick instrument has been defined at 0, the Euro USD, and then the position amount has been defined at 0. We bring in the Williams percentage R. So far so good. And here we define it at 10 minutes. As I said, we are going to use the look back period, and it will be at 3. We make it 3, and this shift will be defined at 12. So 12. Output values, Williams 13 and the Williams are 14. Okay. Now Next, we are going to need the 10 minutes candles historical data, as we want to look at how the last candle and the candle prior to that has closed, and then we will be comparing the closing and the opening levels. And also basically it is going to be a lot dependent on the price action. So even the title might have been like price action with Williams. It works both ways. Now we bring in historical candles, and for that we will need to look at the info section. Get historical candles, and we will need 10-second candles as well to define the price action around the chosen price point. So we will need to bring in that as well. Here it is fine, the default instrument. Oh, default instrument has been defined for Euro USD. It is 10 minutes. All right. We will hard code it. Sometimes if it is not hard coded, it changes the configuration when we customize the parameters while running. We take shift 1 last candle and then shift 2 the prior candle to the last one. Again we hard code this one 10 minutes. Okay, bit and this shift 2. As I said, we are also going to need 10 seconds historical candles to pinpoint the entry and the exit points. We keep the default instrument and then we change this to 10 seconds. Okay, it will be shift 1 and it will be shift 2. Now we have got this much data, and let's again go back on chart to see how we can define the conditions. So here let me find one example where we might have felt that our trade should have happened. So I think it looks like here it should have happened. So let me see. The time is 13:20 GMT. So 13:20 GMT is somewhere here, and then we see the 3 look back period is 1, 2, and 3. Okay, this condition is also fulfilled. Then we need to go back 2 hours, and for that we need to go to 11:20. Okay, that condition is also fulfilled. So what happens after this some correction from this oversold scenario, we get the price somewhere here, and whenever it will starts to fall, so we are looking at the ATR or the 10 minutes candle, and now here it is 8 pips. So what we do, we take the 30% of the 8 pips, we then put the order using the sell stop, not limit. It will be a stop order, as the price is going to be lower than the current and we will be selling lower. So whenever the price candle closes and the price starts to fall, we will be placing this order somewhere around 30% lower than the last candle's closing price. And then, or even you can do it another way. You simply define this closing level and then you compare. Whenever the 10 seconds candle will close below it, you can simply uh, deduct the 30% from the last tick price, and then the order will come somewhere 2.5 pips lower, and whenever the price will start to fall further, it will sell it. And then when it goes down again, the 8 pips order, suppose if you are putting it simply at the 100% of the ATR of the 10 minutes, then the order will be placed for the 8 pips, and it will be hit pretty soon. Even if it is multiple times, it will be hit either way. So I think it should work that way. So let's go back, and we will need to define now the buy entry and the sell entry price. And since it will be a pending order, we will need to do a lot of calculations as well, and then we need to define for the stop loss and the target price as well. So we take in mathematical calculation expressions blocks. We are going to need many of these, as we will need to do a lot of calculations. And for determining the buy entry and the sell entry price, we will need to do the addition and the subtraction. So let us start doing that precisely. As I said on the chart, the trigger point is going to be the last candle's closing levels, and we will be comparing the 10 seconds candle, the last 10 seconds candle, and the candle prior to that. So whenever the price starts to fall below these closing levels, we will simply deduct the 30% of the 10%, 30% of the 10 minutes ATR, and we will place the order. Now let us get the last tick, and since it is going to be a sale order, I think it will be prudent to deduct 30% from the bid side. Okay, and we have to define the ATR value as well. So okay, we are yet to bring in the Williams R have been brought in, and the historical candles have been defined. We need to first bring the indicators and we got ATR. We will first need to do the multiplication of the ATR value by 0.3 to set it at 30%. We do this and we 10 minutes. Euro USD shift is going to be 1. So it is, and we get the output value. After the output value, we take the line 25 and then we multiply it. We create a new variable of type double. Let's name it ATR range AR, okay, and 0.30. You can suppose if you want to make it 50% or 100% or even 10%, you can do that. So that's what I'm explaining. As we are utilizing the 30% of the ATR range, it is 0.3. You can change this factor as per your wish. So there is no restriction on that, and we do the simple math. The MS Office terminology A1 into A2, okay, we get the ATR range pips ARP, okay. Now we have got the exact factor which will need to be added or subtracted depending on which side of the trade you are. Suppose if you are selling, then you will need to deduct it. If you are buying, then you will need to add it. So we take this result of the calculation here and we add it for the buy side. So A1 plus A2, it might create some problem. Even it is fine, but still suppose if the spread gets too high, sometimes it happens occasionally, though it is usually not the case. But I think it will be better if we add it to the tick ask, and instead of utilizing the tick bid for buy, I think we convert this to the sell side, and while determining the buy entry, we will add this ARP to the last tick ask value, okay, and the result of the calculation will be SE. Got that. And here we define the sell entry point, last the buy entry point, last tick ask plus ARP, the ATR range pips, and we get the buy entry point. And with this, we also wrap up the session as we are almost running out of time. So we will be back tomorrow, and then we will try to complete the setup. BE. Okay, so these are the points for the execution of the order, and we will now need to build on it in tomorrow's session. So we have got so far within the limits of the time. So thank you all for joining in. We will be back again tomorrow. See you guys. Have an excellent day ahead. Goodbye.